another Talk About It Tuesday. And today's question, I'm sure, is on everyone's minds if you've been paying attention to the financial news, if you have some stocks or you have a 401k. You noticed in the last month a lot of extreme volatility. I mean, literally last month in the stock market was the worst it's been since March of 2020 when we had all the shutdowns because of COVID. So there are a lot of concerns people have regarding their positions. So listen to this question. Should I be concerned about quantitative tightening in regards to my short-term positions, less than 3 years? As I understand it, the last time this occurred, it roiled the market. All right, so quantitative tightening, I know that's a scary term, but let me just give you a little background on that and what it is, and then how it affects possibly your investments. So many of you probably have heard of the Federal Reserve. So the Federal Reserve is the central bank of the United States, and it has a role in creating money, credit for the U.S., keeping a healthy economy. It has a major role in maintaining the health of the economy. And when we say health of the economy, they try to keep inflation under 2 to 3% annual. They try to keep unemployment under 5% annual. And so when things go beyond that, they have a set of tools called monetary policy that they can implement to try to bring back that stability. Because there are times when we have outrageous inflation, right? Like right now, I believe it's 6.81%. And if you compare it to last year, 1.36%, right? We had one point, which is great, to a huge jump, almost 7%. Inflation's out of control. That means you're paying significantly more this year for the same goods and services that you did last year. You're paying way more. I'm sure you felt that. And so again, they have a set of tools that they can use. Now it's interesting though, because unemployment is only about 3.9%, so it's under the 5%, although there are many, many unfilled jobs. And so why, right? We have to ask ourselves why first, and then what can the Federal Reserve do to try to ease that or change that to bring things back to stability? One thing happens when you inject a lot of cash, which they did, the government did with their fiscal policy and then the monetary policy put together. There was a lot of money injected into the system when everything shut down to try to prevent a depression. And so there was a lot of stimulus money that was injected into the system. Interest rates were intentionally held low, which meant borrowing could continue. And you saw certain companies, especially big tech companies and everything, grow tremendously. And you saw a lot of companies borrow, right? There was a lot of basically free money to be borrowed and free money handed out. So what happens when people have free money? Well, businesses expand. Why? Because people spend money. When people spend money and businesses expand, they have to hire more people, right? However, they expanded and there are not enough people who are going back to work. Maybe because of the virus, or maybe they're just people are tired of certain types of jobs. There's a whole range of reasons, but the demand continues. So what happens when you have a huge demand? If supply can't meet it, then prices go up. Well, why is supply not meeting it? Well, because again of the virus, and we have shutdowns, and people aren't going back to certain types of jobs, and we have logistics problems. The supply chain has shrunken significantly. The demand is strong because of all the liquidity in the market, right? All the money that's still out there. So that's caused significant inflation between last year and this year. So the Federal Reserve has to do something to curb all this desire in the market. And how do you do that? Well, you have to reduce the amount of money that's in the market. And so maybe you've heard of quantitative easing, because that's a more common term that's used. And that's basically the Federal Reserve's way to create money, right? So basically, they put money on their balance sheet and they buy government treasuries, bonds from financial institutions, which allows those financial institutions to then have money, which they then lend. And because people had low interest, they borrowed. And it's this cycle. And anyway, there's a lot of money out there. And since there was so much money out there with quantitative easing, now the Federal Reserve is talking about quantitative tightening. And what does that mean? In a nutshell, they're going to reduce the amount of bonds they're buying in order to reduce the amount of cash that's in the system. And they're also simultaneously, which wasn't part of the question, talking about raising the interest rate 4 to maybe 5 times this year, which will increase the amount of borrowing and credit. And so it will reduce the amount of credit, it will reduce the amount of money that's in the system, which will cut down spending and take away some of the demand. And so in the hopes that supply can catch up, this will hopefully balance out the economy. But what does it do to your investments? And just the announcement of new monetary policies created this frenzy in the market, in the stock market. And I assume this person talking about their positions in the stock market. And when people hear, to get nervous, they sell a lot of things that they have in the stock market and they start moving towards bonds themselves, right? So if interest rates are increasing, then bonds become more attractive and stocks become less attractive when you talk about you're trying to stem the growth of companies. And so just the announcement of it, if we look at, again, last month was probably, the worst month. Absolutely was the worst month since March of 2020 because there was massive sell-offs in the stock market. So the question is, what should this person do in their short-term positions? And they define that as 3 years. A 3-year position, first of all, it bounced back. Things are starting to bounce back this month, right? Because the panic, the market loves a story. The market loves, a panic story, a tragic story. And so a lot of the frenzy created a lot of volatility. A lot of people benefited from the volatility. If you were a trader, an options trader, you could benefit from the volatility. If you were a person who, buys the dips or cashes out on the highs, then you profit from the volatility. It depends on your investment style and your investment strategy. I personally didn't take much of a hit in my portfolio because of my investment strategy, right? If you look at what took the hits, the tech companies took hits, right? Which are basically the growth companies. Financial institutions took hits. Those, of course, because they're affected, directly by monetary policy. So if you have what we call value companies, and that's basically what I do. I have long-term holdings that pay me dividends, and I look at the value companies like the Coca-Colas and the McDonald's and things of that nature. They didn't really move very much at all. So one thing I would tell everyone is to really evaluate your portfolio and see what's in it, right? And so is it heavy in certain sectors like tech? Is it heavy in just growth companies that were overvalued over the last couple of years? And you really need to look at that and then weight your positions a little bit differently, right? So that means you might have to change how much, what percentage of these home runs that you're trying to get from the growth companies as opposed to the value companies. But in terms of how will it affect, there's no way to know. And did it roil the markets last time? Yes, but it was a different market caused by different things, right? We were coming out of the Great Recession, and then we had this, quantitative easing to help the recovery, and then we had to slow it down. And yeah, it did affect the markets, but what happened? They bounced back, as they always do. So I would personally reevaluate my portfolio if I were you, constantly, and not just because of this. I would look at where my holdings are and what could be affected immediately. So you might, again, want to start moving towards some of the value companies as opposed to some of the growth companies. You might want to move a little less, be a little less heavy in the financial institutions and move over. You might want to really start diversifying and move some things out of equities or stocks into maybe some other areas that basically give you money from interest. Maybe into bonds, maybe into lending, maybe into other areas. And a well diversified portfolio is important all the time anyway. So if you took a real big beating, it's really a sign to you that you were too heavy in certain areas because the total market didn't take a beating, right? Even though if you look at the indices, certain indices are down, but it was only a few companies that really dragged it down because those were the same companies that were pulling it up when there was a tremendous amount of money in the market. So it's a good question. I don't think as a long-term investor you should do much different except, like I say, evaluate where you're weighting certain things. But 3 years out, the market will be so different. Just use certain tools like stop losses. So in case things bottom out in your particular holdings, that you won't lose it all. But other than that, again, reevaluate, use the tools like stop losses, and just kind of, ride it. When things go down, things are on sale, that's a good time to buy. And when things are high, of course, you don't buy as much because that's how you make your money as an investor. So great question. Like, share, subscribe. Keep the questions coming, and I'll see you next Tuesday.